As I mentioned in the email, it's just a half-hour webinar at the end of the day. So I want to spend the first part of it just talking about just going through a few sort of basic points that I want to highlight. About the market, what I think it might do. I'll look at the charts of the market. I'll highlight a few stocks that I like that I've mentioned in the Dynamic Investor report, and basically where I see them going at the moment. So hopefully that only takes the first half, and then I'll get to the second half, which is also obviously the popular bit, which is I'll have a look at the Q&A box. You could just type in what you want me to look at on the chart, and we'll do that in real time and do some charting analysis. Of course, I won't be able to fit everybody in, and I do have my Thursday videos as well. Whatever I don't fit in, I'll try to fit in the Thursday videos. So, okay, so basically, of course, all the advice is general only. So I guess in terms of trying to set the scene, look, the market's a bit all over the place at the moment. As we know, the RBA raised rates today, sort of expected, but clearly the market didn't like it. So we're just going through this sort of rough phase. But it's been a very interesting year, as I've mentioned previously. A lot of things to worry about, only for those to not crash the market and make it roll over. So, just going back over the last couple of months, looking at the bearishness and the levels of cash. So there was this sort of Bank of America survey from March, highlighting that for 15 months now, cash levels have been above 5%. And the only period that saw a higher cash allocation for a longer period than that was the 32-month bear market back in 2002. So obviously extreme cash levels over the last 20 years. There was also recently a survey done by Capgemini, surveyed high net worth individuals, and again, cash levels quite elevated. So where there used to be about 25% cash, we're now looking at up to 34%. Of course, we've got more news on how bearish everybody is. So this is from just a few weeks ago, mid-April. So looking at fund manager surveys, this was done by the Bank of America. So allocation to equities relative to bonds has dropped to its lowest levels since the global financial crisis. And cash levels for the allocation of bonds, the highest since March 2009. So, for those that were around back then would know that March 2009 was the bottom of the market. So the reason why I point this out is, there's a lot of cash, and instead of taking that as a negative view, I view it as a potential positive, because that money will need to get into the market. And quite interestingly, when you look at how the US market has traded, the US in particular, since the start of the year, it's just steadily increased. We haven't seen any huge pullbacks in the market. And the reason why most probably is because there's a lot of cash already on the sidelines, and there's not really many stocks to sell. So that can only really go one other way, and that's to buy stocks. Clearly, we're not seeing that money move into the market with gusto, but it's something to be aware of. So there's a few other charts that we've put together that I thought were interesting. Now, this is looking at consumer sentiment in the US. University of Michigan, consumer sentiment is in red, and their housing index in grey. So the point here is, what I'm looking at is the bounce in consumer sentiment. So consumer sentiment is still very low, but it's improving, and we can see that last time it improved from these sorts of over, very poor levels. Again, we're looking at sort of GFC lows, the dip that the market had in 2012. So again, potentially we're setting up for better times ahead. What I have here is so in red, we've got the Australian BBB rated corporate spreads over swaps. So basically it's a measure of how much risk that corporates believe is out there in the world when issuing their bonds. And as we could see that if we're looking at the left-hand side, it's come back from an elevated level, and it's already started to ease off. The grey line is the ISM PMI, which is a very good indicator of economic activity. So that scale's inverted on the right. In other words, it's been up at a very poor level, so under 50, showing contraction, but already maybe early signs are starting to head the right way. In other words, in terms of economic activity, we could be in a bit of a trough around these levels. Now, this chart that we put together shows the relationship between the ISM PMI and the share market. So key points is, so when the ISM's above, so when the PMI is above 50, it indicates expansion. Under 50 is contraction. Now, if we look at whether it's heading upwards through 50 or downwards under 50, and so on, that can also tell us what the economy is doing. So in other words, if it's dived under 50, that's a contraction in the economy. But if it then starts to head back up, so it's still under 50 but heading upwards, it means that contraction is slowing down and you're getting ready for the expansion phase. So we think we're potentially in that phase. The ISM PMI hit a low about 3 months ago. It's since been higher, even though last month was slightly lower than the prior month. But there is a good chance that we're in the growth phase, or the very beginnings of a growth phase. So when you look at the way share markets perform, this sort of phase only occurs about 10% of the time. So it's not often we're in this phase, and that makes sense, one every 10 years potentially. But once you're in this phase, looking forward, the market in terms of annualized returns on the ASX 200 is 21.8%. So we're potentially in the strongest part of share market returns, really. Has economic growth bottomed? Was it 2 months ago? Is it 2 months from now? Give or take, we're sort of at that stage. In other words, we need to be looking forward and not getting even more and more defensive at this point. Look, if I'm wrong and the PMI hasn't bottomed and it's got another few rough months ahead of it, then we're in phase 4, where you've got an annualized return of minus 4.5%. So I think the downside from here compared to the potential upside lends itself to you wanting to get involved in the share market. Now, where to get involved? Well, I still think resources is the most logical place. It's had a rough several weeks, of course. This interesting chart. Look, it is only till the end of last year, but it hasn't changed that much, and that's base metals. The days of cover in terms of inventories, and what it's showing here is, we're basically at record low levels. What that means is, everyone's talking about slow growth in China. So, okay, the demand isn't there at this very point in time, but inventories have been run down, and we know that that's been a cause for iron ore weakness. The inventories have been run down. Copper famously is running at extremely low inventories. So again, what that means is there's not much there in terms of commodities in inventories. So as soon as demand does pick up, inevitably it will, there's going to be a big problem with supply as soon as demand picks up, and of course that leads to higher prices. Now, the other reason why commodities can do well is the interest rate cycle. So if you look back over the last 150 years, what you'll find is when interest rates are quite low, the commodity sector tends to be starved of capital because the money flows into usually tech. So low interest rates, technology, something that can give you the promise of very high returns down the track. But then as interest rates head higher, the money moves out of that sector and into boring sectors like commodities. So, commodity stocks actually did really well in the Great Depression and just after. So I still think that's a good space to be involved in. I just want to move on to a few charts so we can get to the Q&A. So in terms of the broader market, that's the ASX 200. When we last had this webinar in April, we're talking about how we highlighted in our dynamic investor report, the oversold nature. So you got the bounce, but of course it's eased back. I mean, I had a chart of this in today's report. Just looks like a bit of a bull flag. We just need that to resolve itself. So the overall picture is still looking constructive. And if I move to a weekly chart, something I've highlighted before, to me, this looks like a big inverse head and shoulders. So what I mean by that is you're hugging the underneath of a resistance line, which means most likely you might break through it. And I wouldn't be surprised if later this year our market is making new highs, as opposed to the consensus view, which is a recession will lead us to much, much lower levels. I mean, I think if we head to lower levels, it'll be due to a black swan event. I don't see, the current issues we're dealing with sending the market down here. As I pointed out before, everyone is, most people are bearish. That's the consensus. Therefore, they're already sitting in cash and they're already underweight. So that's our market. And in terms of the S&P 500, there's just nothing wrong with the way that's steadily moving up there. That's an uptrend either way you look at it. Recent sort of breakout here, okay, it'll test a bit of resistance, but it could pull all the way back here to 4,000 and still be in the uptrend. So at the moment, I don't see any dramas. In terms of individual stocks, I'll just get this out of the way. I still really like Linus. So we've covered this. So we've covered Linus a couple of times in the dynamic investor. So we had the false break at the bottom. It was the first sort of buy signal, then the gap up, the next one, and that's just trending higher. So I think this is one of the strongest looking stocks at the moment that I'm trading, and I think this will continue to recover. Other commodity stocks, IGO, another one that we've liked a couple of months ago. We could see that one stepping up quite nicely. That should continue to do well. The big miners have proven to be a bit tricky, to be honest. This sort of move here was not what I expected. So, I didn't quite pick the turnaround in BHP. But having said that, something I think looks very interesting is this sort of false break. And to me, this reminds me of, I had a cracking trade last year in Fortescue, so I'll get rid of some of these lines. Similar thing, Fortescue. This is Fortescue November last year, broke down, gapped up. I mean, I'd love to see that again on BHP. I'm not won't be that greedy, but for me, it's a similar pattern. You got that false break and it's gapped up again. So although it went lower, it went a bit lower than I thought it would. I think, look, it's redeemed itself these last few days, and look at that volume. And since we're talking about Fortescue, I think that's reversing here as well. For a couple of stocks outside of resources, Charter Hall, again, it had that false break in April like Linus did, but hasn't shot up. So this is another one that we've had in the report, meandering higher. I think that one looks interesting. Again, this is, we're talking property, we're talking office property, not a crowded space. So you want to be there before it gets crowded. And the other one, of course, is Goodman Group, which I still like. this is building up nicely, consolidation. I think an upside break here, if you don't have Goodman Group, that's a buy. And in terms of local tech stocks that we've had in the Dynamic Investor, XDC, sort of tech, still happy to hold this one. So we looked at only as recently as here, really, but it's looks solid trend. This is a little high sort of bull flag, and of course zero, sort of the rounding out there. Someone's asking me about this one. Look, very, very solid move here, but you'd expect some sort of consolidation. So there's a few stocks from the Dynamic Investor. If you don't get the Dynamic Investor report, I'll send an email tomorrow with a special offer, so you can pick it up. Okay, so there are a few stocks that have been in the report and that we've been trading we like, but I'll move on to some of the Q&As now. So we'll go in order. I've got Richard asking about IEL and TWE. So we've got, look, IEL, obviously a big drop on volume and then the quick snapback. But I think this one might need to base first. I'd be very surprised if it's up here. It's not impossible. But look, I think after that initial recovery, you'd be inclined to hold it here. And Treasury Wines, yeah, that doesn't look very good. So yeah, it had that it had that drop like IEL did, but it hasn't bounced. It's just continued to fall on volume. So look, it is looking oversold, but looking a bit ugly, in my opinion. James Hardie looks great, to be honest, the way it's sort of reversed here. If you look at the weekly chart, it becomes a bit clearer that you might have, that could be an inverse head and shoulders low, and it's only just broken out. So again, if we're talking economic recovery, James Hardie will do well, with a few bumps along the way. But I think I think this one's turning around. BlueScope, we had that one in the Dynamic Investor report this morning. Our analyst likes business. In terms of the chart, you can see that the daily chart's it's a mess. You can't trade it. It's you'd have to pick it up as a longer term position, and it's got a trend there, but you can't run a tight stop, you'd get thrown out. So, you'd have to be looking at weekly closes under these levels. Lovisa, wow, okay, that clearly looks terrible and too early to know whether that's if it's going to stop there, to be honest. A2 Milk. So obviously this, very ugly price action here. This would have been the first warning sign, really. So you had this, that would have been a breakout that you could have bought. That would have been the day you unfortunately would have had to turn around and sell it because it was a false break to the upside. So it's usually when you get false breaks, it'll rip to the opposite direction. So you need to act pretty quickly. Look, in terms of here, it seems like it's rounded out and gapped up, but closed on the low. A lot of volume. So I think we need to see what it does tomorrow. If it comes back here and closes that gap, I don't think there's a trade there. It needs to open up quite a bit higher tomorrow. The next one, NRZ, look, I might skip straight to your Appen one because very interesting. There's a reason why I've got that line there. I was talking with Peter Switzer only a few weeks ago, and of course it's a dog of a company, but we're looking at it here, and here is a classic example of one of these false breaks. So opened under the line of support, but it closed above it by the end of the day and managed to hold on. And again, as I mentioned earlier, when you get these false breaks, it rips high, and that's exactly what happened. And look at that. It's gone straight through resistance here. It's coming back to do a retest. I'd be happy to hold this one. In terms of buying, you need to see it bounce here again. Obviously, there's a lot of volume. going in. I don't know how high this one can go because it has been, the business isn't in the best shape, but in terms of a chart, so far doing all the right things. We have SYA. Sayonara Mining. Look, not really much I can see on this. It's just, flat mining. Obviously a gap down there on volume. Maybe they were raising money. Yeah, there's not really much I can tell on that chart, to be honest. Next one, AGL. Yeah, so I've looked at this one recently. I've got a few lines on it, but look, an impressive move. I'd like to point out that longer term, not very good, but I mean, you can't chase something like that. I mean, you could see the divergence here in the RSI. It's not enough to sell it, but you couldn't be chasing it. You need some sort of setup, some sort of consolidation to buy into. Okay, we've got NEC. So it looks like it's sort of base building here. You'd have to look for some sort of break to the downside or upside to know where the next move is. Until then, just keep an eye on it. Okay, HGO. Not really much I can see on this chart. So, look, bit of a sell-off and a bounce back up, but not really any follow through. Okay, Woodside. Bit of a, look, it is a bit of a messy chart, longer term, heading higher, but no real obvious patterns. Look, nice move off the low. We could see this dip here getting recovered quite well, and it looks like it's trying to break higher. I do note that in also in that sector, Santos is breaking higher, and Worley's is looking very good as well. So I think we might see some more upside for that sector. Okay, Hello World Travel. Look, just got a fairly decent trend to it. Let's move to the weekly. Okay, so on the weekly, we could see that's a clear level. So basically, you'd be looking at, if it was to break above $3, that would be very significant because it's tested it on so many occasions over such a long period of time. So this could end up being quite a cracker of a trade, to be honest. If it gets through $3, you'd be looking for a swift move up to $4. Newcrest, well, it's obviously got the bid on the table. Look, nice move here. I sold my gold stocks in early April, worked out for Newcrest, maybe not Evolution, it did go a little bit higher, but we still made something out of it. So to me, gold just feels like a very crowded trade. Everyone seems to love gold at the moment. I haven't heard a negative word about it. So I'd just be cautious around that. But if I just look at this chart, we could see, nice sort of volume there off the lows, potential buy signal with the MACD. Similar to Northern Star, they both look like they want to head higher. So I'd just give it a bit more time just to see if they can follow through. PME, I did spot this one a couple of days ago. It was looking pretty good. Okay, a bit of a sell-off today, like the rest of the market, but look, very nice sort of uptrend. You've had this sort of pullback, the levelling out, and then a bit of a move up here on volume. So despite today's move, I think this one would be heading higher. Okay, ILU. get rid of some of these charts. Yeah, I had this in the dynamic investor as well, I think last week. So look, nice trend. Look, consolidation under that high, starting to break higher. So I just think this one will continue to head higher. Okay, we'll just do a couple more charts. CLG, yeah, pretty clear breakout there on volume and decent follow through. You couldn't chase it up here, but yeah, you would have had to have picked it down at these levels. It's a hold, but I wouldn't be chasing it up at these levels. Okay, last one is GTK. Yeah, okay, so it's going up. Fantastic movement. Sort of gap up here, consolidation. I'd be looking at the volume, so good volume here. Lower volume on the way down. To buy, I'd be looking for a reversal. I mean, has it topped out here? Is that sort of a sign of exhaustion? Everyone getting excited and piling in at the last minute. If I was holding it, I suppose I'd probably use this as my stop. I'd keep it fairly tight now. I don't want to give up all of these gains and look to get in on a higher volume reversal. As I mentioned, if you'd like to join the Dynamic Investor Report, I'll send an email out tomorrow with a special offer there. And that's all for this time. So I'll try to do another one of these in several weeks' time. Fingers crossed I don't bugger up the screen sharing again, and look forward to seeing you then. Thank you.